Ray Dalio just dropped a bomb on Wall Street's playbook, warning we're in the final innings of the biggest economic cycle in history, and most investors are dangerously unprepared. With 75 years of market insight, he's exposing how traditional strategies fail in late cycle chaos, and why diversification, not stock picking, is the real path to survival. Dalio isn't just predicting change, he's declaring war on everything Wall Street gets wrong. Ray Dalio, the founder of Bridgewater Associates with over $150 billion in assets under management, has spent decades developing a systematic approach that directly challenges traditional Wall Street thinking. After 25 years of professional collaboration and systematic decision-making, Dalio warns that we're entering the seventh inning of the biggest economic cycle in history. Dalio explains, "If you know the principles, it's like giving a man the fish ability to fish, rather than to just give the fish. I can tell you what I think, but if these principles are right, then you could apply them yourself to whatever time or circumstances exist." Dalio's revolutionary method centers on writing down decision criteria for every investment choice. Every time I would make a decision, I would write down the criteria I used for making those decisions, because cause-effect, everything happens because of a cause. And the same things happen over and over again. This systematic approach enabled Bridgewater to grow from an apartment startup to the world's largest hedge fund. The economic machine operates as a perpetual motion system driven by four major forces. Productivity represents the most significant long-term driver, though it appears invisible during daily market movements. Real GDP data stretching back to 1900 demonstrates how productivity growth creates an inevitable upward trajectory. Even the largest economic disasters appear as minor bumps when viewed through this lens. However, productivity growth is currently declining in developed countries as they reach later stages of their long-term debt cycles. Short-term debt cycles, typically lasting 7 to 10 years, create the business cycles everyone recognizes. When economic activity slows, central banks produce credit, which functions as buying power. Credit is buying power, Dalio notes. So they produce that credit, it makes purchases of goods, services, and financial assets happen, and so the economy picks up. As the cycle progresses and unemployment drops, central banks apply monetary brakes by raising interest rates, eventually triggering the next recession. The current cycle has run for 9 years, placing markets in a vulnerable late-stage position with unemployment rates comparatively low and reduced economic slack. Historical data shows that late-cycle periods correlate with less attractive returns and greater market vulnerability. Long-term debt cycles represent the accumulation of shorter cycles over decades. The pattern we're experiencing mirrors the 1930s crisis remarkably closely. In 2008 to 2009, interest rates hit zero, forcing central banks into quantitative easing programs. The same sequence occurred during 1929 to 1932, followed by money printing and financial asset purchases. Both periods created substantial wealth gaps and contributed to political polarization. Political cycles now represent the wild card disrupting traditional market patterns. The wealth gap has reached extreme levels, with the top 0.1% of the population holding net worth nearly equal to the bottom 90% combined. This disparity has generated populism on both the left and right, creating the most politically polarized environment since 1900. Republicans have become more economically conservative than ever recorded, while Democrats have moved further left on policy positions. Dalio monitors 3 critical equilibriums that determine market direction. First, debt growth must align with income growth capable of servicing that debt. When debt expands faster than supporting income, mathematical adjustments become inevitable. Second, economic capacity utilization requires balance, neither overheating nor depression. Overheating triggers monetary tightening, while excess slack prompts stimulative measures. Third, projected returns must maintain proper hierarchy. Cash yields below bonds, bonds below equities, with appropriate risk premiums between categories. The golden age of capitalism is ending based on measurable factors. Corporate profit margins have more than doubled since 2000, meaning stock markets would trade 40% lower without this expansion. Technology has systematically replaced workers while globalization enabled companies to optimize operations internationally. Companies with global operations, reduced union membership, and technology adoption have achieved superior profit margin growth. However, these tailwinds are reversing. The bottom 60% of Americans have experienced zero real income growth since 1980. Federal Reserve surveys reveal that 40% of Americans cannot raise $400 for emergencies. Corporate tax rates have reached historic lows with limited room for further reduction. Cheap money policies enabled stock buybacks and mergers, but central banks are losing monetary ammunition as interest rates approach zero globally. China's rise follows historical patterns of power transitions. Dalio's research into world reserve currencies, from Dutch guilder to British pound to US dollar, reveals 6 factors determining national power: innovation, technology, education, competitiveness, economic output, and military strength. Technology serves as the ultimate driver, from Dutch shipbuilding capabilities to current 5G and semiconductor competition. Chinese markets are expanding rapidly in both market capitalization and debt securities, positioning China as a permanent influence on global investment flows. Dalio's investment framework operates on mathematical principles rather than speculation. Actual market values equal total spending divided by available quantity, requiring analysis of spending motivations and asset supply. Asset classes must outperform cash over long periods, otherwise economic gears halt. However, this outperformance cannot remain consistently positive without significant volatility. The diversification revolution challenges fundamental Wall Street assumptions. Most investors commit the critical error of chasing previous winners rather than recognizing expensive assets. The biggest mistake of most investors is that they think that the investment that did well is a good investment rather than a more expensive investment. Risk balancing differs completely from dollar balancing. A 50% stock, 50% bond allocation fails because stock volatility exceeds bond volatility by more than double, creating unbalanced risk exposure. Proper portfolio construction requires risk-weighted allocations across asset classes. Dalio declares, "The Holy Grail of investing is to find 15 or more good, uncorrelated return streams." Mathematical modeling demonstrates that 5 uncorrelated return streams reduce portfolio risk by more than half. 15 uncorrelated streams cut risk by nearly 80% while maintaining returns, improving risk-adjusted performance by a factor of 5. This explains why diversification surpasses stock-picking ability in generating long-term wealth. Current market positioning reflects late-cycle characteristics with central banks holding limited easing capacity. United States interest rates at 2.5% provide minimal cutting room compared to European rates, already at 0. European Central Bank faces 33% caps on certain debt purchases, creating political obstacles for additional quantitative easing. Japan operates with slightly negative rates and reduced stimulative capacity. Portfolio implementation requires strategic asset allocation balancing growth and inflation protection. Alpha generation demands multiple uncorrelated return streams across different markets and strategies. Bridgewater operates over 130 different market types to achieve this diversification. Whatever success that I've had in life or that Bridgewater has had has to do with knowing how to deal with our not knowing more than anything we know. Dalio emphasizes, the systematic approach requires timeless and universal decision rules tested across all historical periods and countries. If processes fail during specific time frames, the methodology demands explanation of differences and rule refinement. This forces continuous improvement while maintaining consistent operational standards. Asset class returns follow predictable patterns based on inflation and growth expectations. Higher than expected inflation and growth favor certain investments, while lower expectations benefit others. Discount rates affect all asset classes because interest rates function as comparison benchmarks for cash flow valuation. Risk premiums represent the residual after accounting for growth, inflation, and discount rate effects. Dalio's all-weather portfolio optimizes diversification across these fundamental drivers, creating balanced exposure to various economic environments while maintaining mathematical risk controls throughout changing market conditions.